Today, we're diving into the wild, innovative, and, let's be honest, often chaotic history of cryptocurrency. We're going to trace its path from this one single revolutionary idea that was born out of a crisis all the way to the sprawling digital ecosystem we see today. So, how on earth did we get from there to here? It all kicks off right here. And you've got to understand, this isn't just a random timestamp. This is a full-blown mission statement. It was embedded in the very first block of the Bitcoin blockchain, the Genesis block. This headline was a direct shot at the 2008 financial crisis, basically saying, hey, the old system is broken. It positioned Bitcoin as something completely different, an alternative, designed to work outside the control of the very institutions that needed those massive bailouts. And that founding ideology, that idea of building a whole new financial system from the ground up, well, it's got a modern name now, Decentralized Finance, or DeFi. It's the core promise of a more open, more transparent, and hopefully a more efficient system, one that's totally free from the traditional gatekeepers. This concept is really the thread that connects Bitcoin's origin to every single innovation we're about to talk about. All right, so to really make sense of this whole evolution, we've broken it down into 6 key eras. We'll start at the very beginning with Bitcoin's genesis. Then we'll jump to Ethereum's world-changing ambition. We'll navigate the crazy ICO boom, build with DeFi's Lego bricks, explore the cultural explosion of NFTs, and then finally, we'll take a hard look at the challenges that are still ahead. So it all began back in October 2008 with a white paper. It laid out this radical new vision for what it called a peer-to-peer electronic cash system. The idea was actually pretty simple, but it was also incredibly profound. What if we could send payments directly from one person to another with no bank sitting in the middle? In those early days, it was all about the code, not the price. But then, in 2011, Bitcoin hits $1, and suddenly, the world starts to pay attention. Of course, that excitement was met with a hard dose of reality almost immediately, when the biggest exchange at the time, MGOX, got hacked, sending the price crashing. But the network itself? It kept running. And in 2012, it showed off one of its most powerful features for the first time, the halving. This is a pre-programmed event that literally cuts the new supply of Bitcoin in half. It was the first real proof that digital money could be verifiably, provably scarce. The next big leap forward wasn't about making a better, faster version of Bitcoin. Nope. It was about asking a much, much bigger question. If a blockchain could be digital money, what if it could also be a kind of global decentralized computer? Now, before we got to that huge leap, we saw the first wave of what we call altcoins. Litecoin's a perfect example. It was basically a copy of Bitcoin's code, but with a few small tweaks, like faster transaction times. The whole idea was for it to be the silver to Bitcoin's gold. This kind of set a pattern for a while, just incremental improvements. But a truly game-changing idea was right around the corner. And that idea was the smart contract. This was the core innovation of Ethereum, which launched back in 2015. All of a sudden, a blockchain wasn't just the ledger for keeping track of who owns what, it was a programmable platform. It meant developers could now build applications for finance, for art, for gaming, you name it, that could run automatically, with no company or intermediary in control. And this moment showed everyone both the immense power and the immense risk of this new technology. In 2016, a project called the DAO, a sort of decentralized venture fund, was hacked because of a simple bug in its code. The community was faced with this impossible choice. Do we reverse the theft by basically rewriting the blockchain's history, a move called a hard fork? Or do we stick to the principle that code is law, even if the outcome sucks? Well, they chose the fork, and that decision split the chain in two, creating Ethereum and Ethereum Classic. It was a powerful, painful lesson that human consensus was just as important as the code itself. Okay, now we enter the era where the floodgates of capital just burst wide open. Ethereum made it super easy for anyone to create a new crypto token, and that capability fueled this massive, completely unregulated fundraising frenzy we now call the initial coin offering, or ICO. I mean, just to give you a sense of the sheer scale of this thing, look at this number. The EOS project raised a staggering $4 billion in its ICO. This was a completely new way of raising money, and it was all happening almost entirely outside the traditional financial system. It was insane. An ICO was basically crypto's version of an IPO, but on steroids and with no rules. It let anyone with an idea and a white paper raise millions directly from the public just by selling a new token. It completely bypassed venture capitalists and regulators. It was a revolutionary idea, for sure, but it also created this total Wild West environment. The market peaked in this crazy frenzy in 2018 before crashing spectacularly under the weight of scams and a lot of empty promises. So after all the smoke cleared from that ICO bust, the serious builders got back to work. The focus shifted away from just raising money to actually creating things with real, tangible utility. And this is where that vision of decentralized finance truly started to get built, piece by piece. We call these the financial Lego bricks. See, developers created these open source protocols for core financial services. You had platforms where you could lend or borrow money, like Aave. You had exchanges where you could trade tokens directly with other people, like Uniswap. And of course, you had stablecoins. The key was that anyone could take these bricks and combine them to build entirely new financial products, and nobody needed to ask for permission. One of the key innovations that made all these exchanges possible was something called the Automated Market Maker, or AMM. So instead of a bank or a traditional exchange matching buyers and sellers, AMMs use what are called liquidity pools, just big pools of tokens that other users provide. An algorithm then uses these pools to automatically set prices and execute trades. It was a totally genius solution for enabling peer-to-peer trading at a massive scale. But listen, none of this DeFi stuff could have happened without one absolutely crucial ingredient: stability. In the Wild West of crypto prices that are swinging up and down like crazy, stablecoins like Tether became the essential backbone of the whole system. By being pegged to something stable like the US dollar, they provided a reliable anchor for trading and lending. It's no surprise they quickly became the most traded crypto assets in the entire world. So next, something really fascinating happened. Blockchain technology kind of broke out of its financial niche and just exploded into mainstream culture. This was, of course, the moment of the non-fungible token, or NFT. Just look at this growth. It's ridiculous. In 2019, the entire NFT market was less than $100 million. By 2021, sales volume had rocketed to $25 billion. This wasn't just a new market. It was a full-blown cultural phenomenon that brought millions of new people into the crypto ecosystem. Now, while NFTs started with digital art, they evolved incredibly quickly. Projects like the Bored Ape Yacht Club turned them into tools for digital identity, for access to exclusive communities, and crucially, Bay AGC gave its holders commercial IP rights to their apes. This established a whole new model, where an NFT doesn't just represent ownership of a JPEG, but a share in a brand. This unlocked a completely new world of utility. But for all this explosive growth, the journey is far from over. I mean, not even close. The crypto ecosystem still faces some really fundamental challenges that it absolutely has to solve if it's ever going to reach its full potential. Security is still a massive issue. As we saw with the DAO, bugs in smart contracts can lead to catastrophic losses. And it's still happening. In 2022, the Wormhole Bridge was exploited for over $320 million. Beyond security, scalability is a huge bottleneck. The most popular networks get clogged up, and using them becomes incredibly expensive. And all of this is happening under this giant cloud of regulatory uncertainty. Nobody's quite sure what the rules are going to be. Now, to solve that scalability problem, developers are building what are called Layer-2s. You can think of them like express lanes built on top of the main blockchain. The two big approaches you hear about are optimistic and ZK rollups. Optimistic rollups work on an innocent until proven guilty model. They just assume all the transactions are fine unless someone proves otherwise. It's efficient, but getting your money out can take a while. ZK rollups, on the other hand, use some really advanced math to prove every single transaction is valid from the get-go. It's more complex, but it means withdrawals can be instant, which is perfect for things like payments and trading. And really, that just sums up this entire incredible journey. We went from one single white paper, a direct reaction to a global financial crisis.
Ahead in the crypto market. Subscribe now for the latest global news and updates.